You have excellent credit, strong income, and enough money for the down payment, and still run into a financing problem when you buy a condo. Why? Because with a condominium, the lender may be evaluating two things: you as the borrower and the condominium project itself. And beginning August 3rd, 2026, Fannie Mae and Freddie Mac are retiring streamlined condo review options that allow some established projects to receive a more limited review. That does not mean that every condo is suddenly unfinanceable. It does mean the association's budget, reserves, insurance, repairs, and paperwork may become even more important to the transaction. So if you are buying or selling a condo in Metro Atlanta, here is what changed and what you should do before the closing clock starts running. Hi, I'm Meck Johnson, a Metro Atlanta real estate broker. I help buyers and sellers understand the parts of the transaction that can affect the closing before those issues become last-minute surprises. This video is general education. It is not lending, legal, insurance, engineering, or association management advice. Loan programs and lender requirements can differ, and the property documents have to be reviewed for the specific condominium and transaction. I also want to say this at the beginning. You may have seen national videos claiming that these rules will make condos unsellable. That is not the right takeaway. The better takeaway is that project financing needs to be investigated earlier, especially in larger condominium communities. Let's make this simple. Fannie Mae calls its streamlined option limited review. Freddie Mac calls its comparable option streamlined review. For loan applications dated on or after August 3rd, 2026, those review types are being retired. An established condo project that previously qualified for streamlined or limited review will generally need the applicable full or established project review, unless it qualifies for a waiver, exemption, or another permitted review route. That distinction matters. The rule is not every condo must pass exactly the same process. Fannie Mae expanded its waiver of project review to certain new and established projects with 10 or fewer units. Freddie Mac similarly expanded its exempt from review option for eligible projects with 2 to 10 units. For 5 to 10 unit projects, whether the project is a part of a master association or larger development can affect that eligibility. So a 6-unit building in Virginia Highland may not be reviewed the same as a 200-unit tower in Buckhead. The legal structure, project size, loan type, and specific agency requirements all matter. Here's where buyers sometimes get confused. The lender can approve your personal finances and still need more information about the condominium association. Depending on the review, the lender may look at items such as the association budget, reserve funding, delinquent assessments, insurance, special assessments, pending litigation, ownership concentration, commercial space, structural or mechanical inspections, and evidence of critical repairs or significant deferred maintenance. The lender may send a condominium project questionnaire to the association or property manager. It may also request the current budget, insurance certificate, financial statements, reserve study, inspection reports, and information about any active or planned assessments. If the association responds slowly or cannot provide the information, the loan can be delayed even if the project might otherwise qualify. And if the documentation shows an eligibility problem, the lender may need additional review, a waiver, or a different loan option. In some cases, the loan may not be eligible for sale to Fannie Mae or Freddie Mac. That is why condo financing is not simply a unit level decision. There are 2 reserve changes, and they do not have the same effective date. First, beginning August 3rd, 2026, if a reserve study is being used to demonstrate that the project has sufficient reserves, the budget must include the highest recommended reserve allocation in that study. The agencies are also saying that the recommendation cannot rely on the baseline funding method, the approach where the reserve balance is allowed to get very close to zero without falling below it. Second, beginning January 4th, 2027, the standard minimum replacement reserve allocation for the applicable full review rises from 10% to 15% of annual budgeted assessment income. That does not mean every association must blindly place 15% into reserves in every circumstance. A qualifying reserve study can provide another path, but the study and the association's funding must satisfy the agency requirements. And this is important. The 15% date is January 4th, 2027, not August 3rd, 2026. If an association has kept monthly dues artificially low by postponing reserve contribution, the new scrutiny may reveal a larger issue. Owners may face higher dues, a special assessment, or deferred work that still has to be addressed. Low dues can feel attractive when you purchase. They are not automatically proof that a community is financially healthy. The August review change is receiving most of the attention, but insurance is part of this story too. For applicable loan applications dated on or after July 1st, 2026, the updated agency rules address master policy per unit deductibles and when the buyer must carry an individual unit owner policy, commonly called an HO6 policy. Under the new framework, a master policy's per unit deductible can be no more than $50,000. When the master policy includes a per unit deductible, or does not cover some portion of the unit interior or improvements, the borrower generally needs an individual policy that provides the required coverage. Do not guess about this from the phrase, the HOA has insurance. The master policy and the individual HO6 policy cover different interests, and the deductible structure matters. The lender and insurance professionals need to confirm what is required for that project and unit. In Metro Atlanta, we may not have the same coastal hurricane exposure that's driving some Florida headlines, but associations still face rising repair and insurance costs. Older roofs, elevators, parking structures, water losses, and large master policy deductibles can still affect owners there. This is not only a Florida issue and is not only a high-rise issue. Metro Atlanta has large condominium towers, mid-rise buildings, mixed-use developments, boutique communities, converted buildings, and townhome-style properties that are legally organized as condominiums. That last point surprises people. You cannot always determine the ownership structure by looking at the building. A property that looks like a townhouse may legally be a condominium, which means the condo project review may still matter. For buyers looking in Midtown, Buckhead, Brookhaven, Decatur, Sandy Springs, Dunwoody, the perimeter area, or other condo markets, the practical question is not simply, do I qualify for this price? It is also, does this project work with my financing? And can the association provide the required documentation on time? For sellers, the question becomes, could an association level issue reduce the number of buyers who can finance my unit? That is where marketability enters the conversation. If you are buying a condo, I would make 5 adjustments to the normal process. First, choose a lender who regularly handles condominium loans. Ask how early the lender can screen the project and what documentation will be needed. Do not assume every lender will reach the same conclusion or will use the same loan product. Second, identify the condominium before you become emotionally committed to the unit. Confirm the legal property type, project name, number of units, and whether there is a master association. Third, ask for association documents early. The exact package will depend on the transaction, but buyers commonly review budgets, financial statements, reserve information, insurance, meeting minutes, pending or recent assessments, litigation disclosures, governing documents, and available inspection or engineering reports. Fourth, connect the financing deadline to the contract deadline. Your lender needs enough time to review the project while you still have the rights provided by your contract. Speak with your agent and closing attorney about the appropriate financing, document review, and due diligence protections. Fifth, read for future ownership, not only loan approval. Passing the lender's review does not promise that dues will remain the same, that no assessment will occur, or that every repair has been fully funded. The lender is making a loan eligibility decision, and you are making an ownership decision. If you are preparing to sell a condo, do not wait for the buyer's lender to be the first person to ask questions about the association. Start by learning who manages lender questionnaires and document requests. Is it the board, the management company, or a third-party service? What are the fees and normal turnaround times? Ask whether recent transactions in the community used conventional financing and whether any lender review issues arose. That is useful history, but it is not a guarantee for the next buyer or loan. Gather what you are entitled to receive as an owner: insurance information, recent meeting minutes, notices of assessments, and the association's document ordering process. If there is a known assessment, repair project, insurance issue, or litigation matter, work with your agent and attorney on accurate disclosure and positioning. Hiding the issue does not make it disappear when the questionnaire arrives. And think carefully before marketing the unit as Fannie approved, warrantable, or easy financing, unless the lender can verify the current project status for the specific transaction. The cleanest listing is not the one that promises there are no questions. It is the one that is prepared to answer them. You are going to hear the word non-warrantable more often, so let's define it carefully. In general, it means the condominium project does not meet the eligibility standards for a particular conventional agency loan at that time. It does not automatically mean the building is unsafe. It does not mean the unit has no value, and it does not mean a sale is impossible. There may be portfolio lenders, community banks, or other loan programs that consider the project using different requirements. A cash purchase is also not subject to mortgage approval, but those alternatives may require a larger down payment, different underwriting, a higher rate, or fewer choices. And a cash buyer should still care because today's project financing can affect tomorrow's resale market. The right question is not, is this condo good or bad? The right questions are, what issue is preventing this particular loan? Is it missing documentation or a substantive eligibility problem? Can it be corrected? What alternative financing exists? How could the issue affect ownership and resale? Before buying a condo, here are 5 questions I would put at the top of the list. 1, has my lender screened this specific condominium project for my specific loan type? 2, what does the association budget for reserves? And is there a current reserve study? 3, are there active or planned special assessments, major repairs, or inspection findings? 4, does the master insurance policy meet the lender's requirements? And what HO6 coverage will I need? And 5, who will provide the lender questionnaire and documents, and how long will it take? If the answers are incomplete, that is not always a reason to walk away. It is a reason to slow down, identify what is missing, and protect your decision while the right professionals investigate. So, will August 3rd change the condo market? It will change the review process for many conventional condo loans. It may expose association problems earlier, create more document requests, and make preparation time more important for buyers, sellers, and condo boards. But it does not place every condominium on a blacklist, and it does not make Metro Atlanta condos automatically unfinanceable. Here is the practical takeaway. For a condo transaction, investigate the project at the same time you investigate the units. Do not wait until the appraisal is complete or the closing date is near to learn that the lender still needs the budget, insurance, reserve study, or inspection report. The earlier the project review begins, the more time you have to understand the answer and make a good decision. If you are planning to buy or sell a condo in Metro Atlanta and you want a checklist of the questions to ask before the transaction gets too far, send me the word condo. I'll help you organize the real estate side of the process and make sure the lender, closing attorney, insurance professional, and association contacts are brought in at the right time. And if you know someone who thinks condo financing is only about the buyer's credit and income, share this video with them. The building matters too.